Back in 2019, when we designed the mandate for ORIT, what we wanted to do was give investors the opportunity to earn a well-covered, stable dividend with an element of inflation protection, but also give them the opportunity to invest in growth in the renewable sector by investing in a company that was actively going out and securing ready-to-build projects and bringing them into operation. And that's exactly what we've done with ORIT. Over the past 5.5 years, we have built the most diversified renewable investment trust of scale in the sector. We've built approximately 500 megawatts of new generating capacity in the UK and across Europe.
So during the first half of the year, we've paid an on-target dividend of 3.08 pence per share. That's in line with the full year target of 6.17 pence. And importantly, that dividend was fully covered by the operational cash flows coming from the portfolio of assets, and the dividend cover figure in the first half was 1.19 times. Net asset value moved to around £540 million, or 99.5 pence per share. That was a decline from the starting period and reflected some increases in discount rates to reflect market conditions, as well as a reduction in power price forecasts across a number of markets. However, on a NAV total return basis, the dividends paid out to shareholders broadly offset that fall in the net asset value. Shareholder return was positive, and that was driven by an improvement in the share price of around 8% from the start of the year to the end of June. Having said that, we're very conscious that there's been continued volatility in the share price since, and we know there's a lot more to do to ensure that the share price and the market capitalisation really truly reflects the underlying value of the assets. We saw revenues coming through of around £68 million and EBITDA of around £44 million. This was slightly below budget, principally because of the lower wind speeds that we saw during the period compared with long-term averages, as well as some grid curtailment, particularly on our Irish solar portfolio. As at the end of the period, the portfolio consisted of 40 separate assets with a total capacity of just under 800 megawatts. And those assets are across 5 different technologies and in 5 different markets in Europe.
We have continued to back our developers, in particular BLC, which is a developer of UK solar projects. And we see an opportunity for that platform as the UK government and grid operators continue to rationalise grid connections in the country. And we've also continued to back Norgen, which is our developer operating in Finland. We also made a conditional investment into Irishtown. It's a 33 megawatt project. It's adjacent to our existing Ballinamacany project just north of Dublin. The economics of that project was such that we thought it was a very attractive opportunity for ORIT and for our investors. Generation during the period was 654 gigawatt hours, which is broadly in line with the same period last year. Solar production was up 34% versus the same period last year. On our onshore wind portfolio, performance was down 18% against budget, principally due to low wind speeds. But what was particularly pleasing to see was that against our weather-adjusted budget, we've seen a 3% improvement, which really reflects that the projects and turbines themselves are operating to a high level of availability. At Lynx, our offshore wind farm, generation was down against budget, principally due to low wind speeds and also some extra maintenance needs. But with our proactive approach to maintenance, we've managed to limit that downtime. And also we expect to see some delayed revenues that will be recognised in future periods.
By the end of June, we had completed £8.5 million worth of share buybacks during the period, and that took the total, including last year's, to around 15 million. So roughly half of the 30 million total that we've committed to. And indeed, since the end of the period, buybacks have continued. So a significant majority of the 30 million programme has now been completed. With respect to gearing, at the end of June, gearing had risen slightly to 47%. However, this should be seen as temporary, as following through on a small number of commitments in the first half of the year has pushed the number up. But with the asset sales expected to come through towards the end of the year, this will bring the number below 40% as expected. On the asset sales of at least £80 million that we've committed to achieve within the financial year, we are on track to deliver that, with well-advanced conversations underway with a number of bidders for some of our operational assets. Later on, during the summer, we were able to announce a change in the management fee arrangements, moving from a purely NAV-based fee to a fee based on an equal weighting of NAV and market capitalisation. And this change not only creates greater alignment between us as the manager and shareholders, but also should lead to a reduction in fees paid of around £0.7 million based on market conditions at the time of the change.
Combination of stabilised inflation and falling interest rates is improving investor sentiment. And from a regulatory perspective, take the UK for example, CP30, which is aiming to rationalise grid connections, and reforms to the CFD system have made it a very attractive place to invest into renewables. And in Europe, the Clean Industrial Deal seeks to set a target of 100 gigawatts of new renewable installations every year from 2030. And that, again, is a very exciting opportunity for ORIT.
New assets are going to bring new clean generation capacity onto the grid, as well as our strategic allocation of up to 5% into developers of those projects that are going to drive the energy transition. As well as that, something that continues to set ORIT apart from the broader peer group is our focus on diversification, in particular having assets across both wind and solar technology, as well as other complementary technologies, and in investing across a range of geographies in our target markets in order to manage both risks of variable weather patterns and government policy, but also to give us access to the broadest possible pool of opportunities as we see this new infrastructure coming through.